Have you ever asked yourself which is better to invest in, treasury bills or real estate? Well, in today's video, I have an expert who is going to help us debate this question, and we are going to come up with the final answer. If we haven't met, my name is Natasha Chumia. I'm the CEO of Diaspora Connect, and on this channel, I like to give you information and inspiration on the Zambian real estate market, especially for you who's living abroad. So if you like the sound of that, then please do give this video a thumbs up and also subscribe to our channel because it really does help us grow and inform more people about the real estate market here at home. Okay, so let's get into today's video where we're going to debate whether you should be investing in treasury bills or real estate. And I have a special expert with me today. Make sure you watch the whole video because he's going to describe some innovative thinking and an approach which actually was an eye opener even for me. Hi, Kalopa.
Hi, Natasha.
How are you?
I'm good, thank you. How are you?
I'm great. Thank you so much for agreeing to have this conversation today. Maybe you could just start by telling everyone who you are and what you do so they understand why we're sitting down today.
Thank you so much for having me. My name is Kalopa. I work with Pangaea Securities, a financial advisory firm here in Osaka. One of my key things is we provide financial advisory to different clients, and that's why I'm here today.
Okay, great. So start by telling us what is government paper and how does it generate returns? Because a lot of our audience is in the diaspora, and I think they want to understand what this whole government paper thing is about.
Government paper is perhaps the easiest to understand in terms of securities. If you want to invest in securities, it's probably the easiest and the safest, actually. It's part of its appealing factor. But the premise here is you buy government paper and then you get a return in exchange. So the government issues paper. It issues either its T-bills, which are more short-term instruments.
What's T bills?
T-bills are
What does T stand for?
treasury bills. I forgot for a second, but it stands for treasury bills. So treasury bills are more short-term. So the way they work in Zambia specifically, it's the government issues a short-term instrument. Usually it can be 91 days to 1 year. So the way it works is you buy at a discount to the face value, and then at maturity, you sell. So here's how it works. Let's say the face value of one T-bill is, for argument's sake, let's say 1,000 kwacha, right? And then the government will sell you a piece of paper with a face value of 1,000 kwacha, and then they'll sell it to you today at, let's say, 950 or 900 kwacha. Okay, and then at maturity, you sell the T-bill, and then you get back 1,000. So effectively, let's say you bought it at 900, you make a 100 kwacha. So that becomes your return. So T-bills is basically where you buy money in a way at a discount and then sell it after a few months. So basically, if you buy a T-bill today, you're basically buying the face value at a discounted price, and then you get the full value at maturity. So that's what T-bills are. But then the government also provides longer term instruments. These are called government bonds. Can be 3 year, 5 year, 10 years. So there are all these instruments there. They work a bit different in Zambia. For example, there's a return or a yield which you get if you buy. Let's use the same example. You invest 1,000 kwacha, right? And then with government bonds, you get an annual return of, let's say it's 15%, for example. Then you get 15% of 1,000 kwacha every year until maturity. Maturity can be 3 years, 5 years, just like that. So that's how those are the differences between T-bills and bonds.
Okay, all right. So thanks for setting that up for us because what we really wanted to debate is which is better, property or government paper. So let's get straight into it and let's talk about the returns. Okay, so I think property still gives pretty good returns, but what kind of returns can someone expect with government paper?
The beauty with government paper, it's risk-free. It's very, very hard for real estate to compete with that. It's being backed by the by the Bank of Zambia. So it's risk-free. Hence, the way we price returns, you need to adjust for the risk exposure. right? So with government paper, inherently they're risk-free. So you don't price in that risk. If I'm going to invest in real estate, let's say my return requirements is it's 14%. Because of the inherent risk of alternative investments such as real estate, I have to price in the risk I'm taking up. And as an investor, anywhere you are, you need to be able to sort of like price in risk, right? If I've got two investment options, one real estate and one and treasury bonds, they're both saying the same returns. Let's say 50% for each. I need to consider that both instruments, they've got different risk profiles. So for example, so for me to invest in real estate, other than to invest in real estate instead of bonds, real estate have to adjust. They need to put a risk premium on top of that. So if bonds are 14%, real estate needs to add a couple of percentage points there on top for it to become attractive. So talking about a higher return. So because of that logic, you can tell to say real estate usually offers more returns only because it has to price in that risk. While treasury bonds offer low returns because because they're risk-free. So the question now becomes between the returns, it's not which one offers a higher return, because by default, real estate needs to offer high return. But the question becomes, what's your risk tolerance? And we can talk about risk as we proceed.
Okay, because I think that that's a good point. It's a very good point about what you're talking about in terms of the fact that government paper is risk free and real estate, like any other investment, has an element of risk. But what I've observed over the last few years is that property gives an excellent return because there's been so much infrastructure development, roads, there's been malls, there's been, different types of development that we're seeing across the country, airports in some cases. And that can really shoot up the value of your real estate investment by 30, 40, we've seen even 50%. So, I mean, can you get that from a treasury bill?
All else constant? No. Okay. All else constant. Hence goes back to my point earlier. It's your risk exposure. You make a good point. You can make 40%, or for example, in terms of appreciation. Or technically, you can lose money.
Okay.
That's still a risk in real estate that is not in government bonds. So it goes back to my point. That's your risk exposure.
Okay, so you've made a very good point about risk and risk appetite. But now let's talk about cash flow because, some people have complained that with real estate, the rentals can be a bit low, especially certain segments of the real estate market. So, how does government paper, and I suppose more so government bonds, how does that compare in terms of cash flow?
Both investments, they have their own dynamics. I always go back to this point. It's very, very important as an investor to understand what you're looking for, portfolio, what return requirements you're looking for, what's your risk tolerance, what are the users of funds, because it's a different dynamic if it's your kids' school fees, you're a college fund and you're trying to invest. So all these dynamics are coming into play. So there's no one size fits all, but they've got very different. And you can speak more to how real estate works. But from bonds, the beauty is bonds and government papers in general, they are relatively more liquid than you would find with real estate. Basically, here's what I mean. It's easier from the time you invest, your returns start calculating. So if I invest $1 million quarter today, and then from the time I invest, there's interest rate accumulating, right? There's interest accumulating. After a while, I receive my coupon payment or I sell. So there is, from the time you invest, in a way, your returns start accumulating. Okay. As opposed to real estate, where you can only accumulate after you're done with construction. God knows how long construction will take. So that's different. The second bit is in the case of an emergency, it's much easier to sell government paper than it is to sell a house. You can speak to this more. How easy is it to sell a house in Osaka, or sometimes how easy is it to find a tenant at the price you envisaged, right? Because if the houses are too expensive, you won't find tenants, of course. So they've got different, really different cash flow structures. So you can easily exit. Government bonds are more liquid. You can easily exit. You get a return on a regular basis. It's guaranteed payments, as opposed to real estate. So that's a key advantage that, in fact, if you allow me, I'm a strong believer that any investment portfolio should always have government bonds. If anything, you can leverage the cash flows or the returns from government bonds to build.
Right. So before you get into that, I just want to come back to something that you said, which is, the guaranteed returns. But Kalopa, one thing that we've all seen is that our economy can be quite volatile.
Yeah.
Yeah. So we've seen our currency going up and down. We've seen inflation going up and down. So when it comes to that cash flow, yes, you might start calculating it there and then, but do you know the value of that kwacha when you receive it?
Well, that's true for real estate too, right? I think currency risk is inherent in Zambia, especially if for your audience in the diaspora who earn in foreign currency like USD, you will have to get that exposure, whether it's government paper or whether it's real estate.
Well, the reason why I don't think it's exactly the same for both assets is because I think that real estate is a better store of value. So you might have inflation and you will have currency fluctuations, but at the end of the day, the house, it acts as a buffer to those kind of shocks. Whereas if today the kwacha devalues or depreciates by 30%, it's depreciated by 30%. It doesn't necessarily mean your house is going to depreciate by 30%.
That is true. I can't emphasize this enough. It largely depends on your investment horizon. So, for example, if you're thinking more long term, well, then that's valid, right? You're not exposed to midterm fluctuations in economic fundamentals. So, if your investment horizon, you're thinking more of, okay, I gotta transfer, I gotta build an inheritance, I have to build a portfolio, then it's different. You're not thinking long term. So, the question becomes, what are you looking for in the market? Investment horizon? Are you thinking more 15 years, I want to transfer an impact to my kids? Or are you thinking, all right, I need money to build my kids' school college fund? So all these things, you have to put them in context.
Okay, so then are you saying that, let's say, treasury bills or government bonds are better if you're thinking short term, and a property is better if you're thinking of a more medium to long term horizon?
I would argue it's very different. It's very different. I wish I can provide a specific answer. It really depends with the return requirements and your investment horizon. There's no size fits all, because, for example, even government papers, they do offer long-term investment horizon. We're talking about 15-year instruments, 10-year instruments. They've got all these options, right? Even treasury bills, they've got shorter term. They've got 91, 100 days. So it's a very difficult question to answer, because it depends with your investment preferences there. So each person, the way I'll play it to actually give, there's no all size fits all type of answer.
No, I agree. I agree. I think it's a lot more nuanced.
Yeah.
But why don't we also talk about the fact that for a lot of our audience, like I've mentioned, they're in the diaspora. And one of the things which I can concede is often a big challenge for them is maintenance. Property maintenance. You're far away. Who's going to look after the property? Who's going to go in and do inspection? How is it if you invest in government paper? What sort of oversight does it require, especially if you're not living here?
Well, first of all, it's much easier. Well, because there's no day-to-day property management. It's not like somebody's gonna break the window. And you don't get exposed to vacancy risk, if I can call it that, or market risk in this case, because if you own real estate, you get a return if there's somebody living there. If there's no one living there, effectively you're not getting any return. So So that's a risk. You have to manage that risk, and you have to work with agents. You have to be more active, and there's also a risk that the person you put in the house to manage the tenant, maybe they're not good tenants. Maybe they break a window or something. So there are all these maintenance which are applicable in real estate, but they're not relevant to government bonds. With government bonds, basically you can print money from abroad. So you sit there and basically print money. So you invest in government securities, and that's why the return requirements are not as high as real estate, because there isn't a lot of maintenance. Here's the thing you need to, before you choose the investment option, I said this before, you have to price in your risk, right? You have to price in your expenses. Just the fact that you're managing an asset from the US or from wherever you are, you need to price that in your risk. So maybe it's 2%, maybe it's 1%, but you have to price in agency costs, right? So if you price all that in, and then real estate is still more favorable, well, then that's the result. But either way, the key thing here is that you have to understand your risk profile and your investment horizon.
You know, when you say things like that, I can understand what you're saying, but I think that for a lot of people, they understand real estate and they understand, like, buying a plot, building a house, or outright purchase of a property. Don't you think that with government paper, it's a bit more complicated? It's not as straightforward, and people have that thing of, do I really understand this? How do I get into it? And what would you say to that?
Government bonds are by and large much easier and less complex than any form of investment, if you ask me. They're much easier. Um, in fact, what we see in the market is when people have money, they're looking for investments, they just feel lazy and just get government bonds. And one of the beauty of government bonds is they're divisible. Okay, unlike real estate. With real estate, what you'd have to do is, if a house you want to build costs $2 million, then you need $2 million to, yeah, if it costs 2 million kwacha, yeah, then you need 2 million, kwacha to finish the house. But with government bonds, they're more divisible, which is the beauty of it. So you can say, all right, since I only have $1 million, you can start with, and that's the point I was trying to make earlier. So you can blend the two. You can match your returns. So, for example, let's say you're saving up to build a house. You're saving up. Maybe you're keeping money at the bank. You know, to say, all right, I'll have enough money to build my dream house or my dream flats in 2 years, which is fine. Let's say today you have $1 million. Perhaps put that million in bonds. Don't just start building just because you have enough money to start with. That's always my opinion. Just because you have enough money to get to window level doesn't necessarily mean that you have to start immediately. Why not wait until there's that much, right? Start with bonds with the money you have. Increase, in fact, it actually reduces the gap you need to raise. Let's say the total cost 2 million kwacha, and then you have $1 million. But if you invest today, maybe you make 100,000 kwacha in profits within 1 year. So I think there's a way there you can match your returns. You can use both of them. But to say government bonds, it's too complex for me. If you are able to pursue real estate, I still believe it's way more complex, because you have to manage so many stakeholders. You have to get the contractors, you have to get all these people together. If you can manage that, you can quite easily, I promise you can quite easily. The beauty here is that you'll be dealing with professionals, banks. They can help you buy treasury bills. They've got experts, they've got people who can help you. Just call your bank. So it's much easier to monitor. You don't have to worry about who's stealing my cement. So yeah, I feel like it's much easier, and definitely not as complex as real estate.
I like the point that you're bringing up, Kalopa, about having a hybrid approach. I think that's a really good way of looking at it. It's kind of innovative. It's outside the box, but I still have to push back a little bit, because you mentioned something earlier on, which is treasury bills or government bonds are much more liquid. It's a much more liquid asset. And then the problem then becomes, if you need cash, when you start building, your cash has gone into your construction project, your building project. So even if you need money or somebody asks you for money, you get those phone calls when you're living abroad. Oh no, this person is sick or this person needs school fees. And you can honestly say that I don't have it, or maybe you put it all into your house. Whereas with these liquid assets, there's that temptation to liquidate. You know what I mean? You liquidate the asset and then you're starting all over again.
Yeah. Well, that's a very, very, very good point, and it goes more towards human psychology, how humans work, how they perceive. It's a spectrum. There are people who are very, very disciplined. They are not touching their government bonds. They are not touching their portfolio. So, and then there are people who are more. So it's and it's. I know I sound like a broken record. I keep saying this. You have to know your risk profile. Perhaps you are. Perhaps you things come up and then you have to cover those costs. So perhaps maybe bonds are not for you, perhaps in that regard. So yeah, like I said, at the risk of sounding like a broken record, you really, really have to understand your risk profile. How am I as a person? How do I invest? So if bonds are not for you, then consider something that where you can't easily liquidate. If liquidation for you is a risk, then don't do things which can. It's like basically keeping cash if you're not to say you're not disciplined, because every time there's a need, you will just get from that cash. So yeah, it goes back to my point. Understand your risk preference and your investment appetite.
All right, so let's talk now about leverage, because one of the good things that most people understand about having property is that you can actually go to the bank and borrow against it. So you can even use that to buy another property or to start building another property. So tell us about how you can leverage off treasury bills or government bonds.
The hybrid approach I was talking about, it can work here. Don't quote me, but I think you can borrow against bonds. You can borrow against bonds, and yeah, first of all, you can borrow. There's the same way you can borrow against real estate. I think you can also borrow. Yeah, don't quote me though. I'm not the expert on this, but I think you can if everything is working correctly. But with bonds, I've seen this in practice where people rely on government bonds returns, not the face value. They rely on returns to build real estate. I've heard of these stories, especially for our higher net worth individuals who maybe have 20 million kwacha in bonds and then they get maybe 1.5. Don't quote me on these numbers. I'm just thinking out loud. Maybe they get 2 million a year. You can build something with 2 million kwacha. So, and then we're talking about maybe higher net worth individuals who own maybe hundreds of millions of kwacha in bonds. Those returns are actually enough to build a real estate empire, albeit slowly, but you have, whilst your principal is protected at the government, you'll get it in 15 years, in 10 years, your returns are being used to build. And then within a year or two, or less than a year, those returns have built a house, you're getting your income. So in that regard, there's dual income, one coming from bonds, one coming.
Yes, but that requires a big investment upfront.
Like I said, for higher net worth individuals, yes.
Okay. We'll keep working on becoming high net worth individuals. Okay. So let's talk more generally now. What mistakes do you see people in the diaspora making when it comes to investing in these instruments back home?
So it's tricky because, in my opinion, the people in the diaspora, they are usually very well educated, okay, well informed, and they have a very good understanding of the market and the options available. In my experience, maybe it's the diaspora people I deal with. So usually the mistakes they make is probably the mistakes any person would make. So I don't think there is a systematic mistake that specific people. But here's one thing I can add. Sometimes, if somebody's working in America, they've got access to cheaper credit, right? Cheaper credit. I don't know what the bank rates in America are, but they're much, much less than what you pay in Africa, in Zambia. So maybe you get a loan at 6%. That's a USD loan, 6%, 4%. And then you use those funds to buy bonds in Zambia. Let's say you're buying bonds at 15% return. So of course there's a spread there of about 10%. Well, you have basically printed cash, right? But then again, Zambia has its own dynamic. There's exchange rate risk.
Exactly.
If the kwacha depreciates, you lose all your value. meaning that you're getting a depreciated return against a USD payback. So you have to model that. So sometimes that is not well understood. Then there's also inflation. Maybe the kwacha is, there's inflationary pressure on the kwacha. So there are all these dynamics that you really, really have to take into account. But mostly it's the exchange rate.
And which is why I still advocate for property because of those exchange rate and inflationary fluctuations.
Because the key thing here is one thing you want to mitigate is the currency mismatch. Okay, you do everything you can to mitigate that. Now, there are options that exist. You can talk to your bank, maybe come up with some sort of an hedging instrument, especially if you're coming from more developed markets. So there are options that exist to hedge against that. But otherwise, the key thing you need to avoid or the risk you need to mitigate is currency risk.
Right. Okay, so the reason why I wanted to have this discussion is that I heard over the last few years where people say, "Oh, I'd rather invest in treasury bills and not real estate," or some people say, "Real estate is for me. I wouldn't invest in treasury bills." What is your final word, Kalopa? I know we've gone back and forth and discussed the pros and cons, I would say, of both asset types. But what would you say is your final word if someone had to ask you, which one should I invest in, treasury bills or government bonds or real estate?
Real estate is good. We're in a country which has a severe housing crisis. There is a lot of demand for housing. There's a lot of demand for proper housing. I think that's a gap in our economy that needs to be mitigated. Maybe your audience who have maybe more capital, maybe high net worth individuals, I think there's so much they can do locally in real estate. Perhaps try different forms of real estate, maybe high-rise buildings, student apartments. I think there's so much demand locally for bachelor pads, for example, for student accommodation, high-rise buildings. We see this happening in more developed markets. In Africa, you go to Kenya, they've got so many high-rise buildings. You go to Morocco, that's what the rest of Africa. I've noticed that that's a severe gap in the market. I think for your audience who are thinking long-term, there is so much they can do with real estate. It's something that the country needs. It's a lack. We don't have a lack. There's no lack in treasuries. You can still make money from treasury bonds. So it depends on your risk profile, right? So, and they keep saying that depends on your risk profile. So my advice is you don't necessarily have to pick one or the other. There is a hybrid approach. There's a hybrid approach depending on where you're starting from, your entire portfolio. Where are you today? And how do you, if you have so much exposure to real estate, perhaps consider bonds.
Right.
If you have so much exposure to bonds, perhaps consider real estate. Either ways, your downside is more or less protected, right? You have capital preservations in real estate. You've got high liquidity in bonds. So you have a diversified portfolio in which you can liquidate when you need to. At the same time, your wealth is accumulating and land is appreciating. And definitely you're solving the severe housing crisis the country has. So it's not one or the other. My recommendation is hybrid approach.
I think that's a perfect note to end on. And I really appreciate that insight. I think it gives us all a lot of food for thought. So, Kalopa, thank you so much for joining me today for us to have this debate about treasury bills or real estate. I really appreciate your insights.
Thank you so much, Natasha. I hope you have me again.
So let me know which one you'd rather invest in after listening to our debate. Would you rather invest in treasury bills or real estate? Put your answer in the comments so we can all debate this and share our views with everybody else. For me, my key takeaway was having a hybrid approach of both treasury bills and real estate based on where you are today and what your risk appetite and your outlook is. So if you found this video informative, then please do give it a thumbs up. Don't forget to subscribe to our YouTube channel if you haven't done so already, and hit the notification button so you don't miss any of our videos. Check out our website for more information on investing in property back home, and chat with us on social media because we love to meet you there. Otherwise, it's bye from me, and I'll see you in the next video.